Joining me now is Tom Porcelli. He's the chief U.S. economist at RBC. Tom, welcome.
Hey, how you doing? Good to be with you.
It's good to see you again. So tell me, I mean, hindsight's 2020, and I hear the refrain. It sounds like you're a believer that they should have started tightening last year. So what should the Fed do now?
Yeah, I mean, and Kelly, I think that's the right. I mean, like, I don't think we need to relitigate the past. I mean, we've been saying basically most of last year that the Fed needed to do something last year, but I think here we are this year. And look, I think while transitory was not the right word last year, and while I think that it's great that Powell keeps on saying that they want to be humble and et cetera this year, I think humble was actually necessary last year. I think this year they need patience. Because I think that there are a lot of risks on the horizon right now. I don't think that the backdrop actually needs the Fed to get very aggressive here. So I know there's a lot of calls out there for the Fed to, sort of go 50 here and there, certainly raise rates every meeting over the balance of this year. We think that the Fed should be much more tempered in their approach right now, given some of these risks out there. And so let's just, well, what does tempered mean? We think that they should go 25 basis points in March. And then we think they should go 4 times in total over the balance of the year. So basically once a quarter. And so what are these risks? I think the risks are basically, look, we have a lower end consumer that has basically tapped out most of the sort of the excess liquidity that they had in place. We think that inflation is going to start the process of slowing down this year, which we think will take some of the pressure off of the Fed. And so there's all these sort of transition things that are happening right now that I just don't think the backdrop necessarily warrants an aggressive Fed at this point.
So to me, I guess what doesn't make sense is this idea that they should have started sooner, except that they should go it slow right now. It feels like it should be one or the other. Either they're behind the curve and they need to catch up, or they're not because of all because inflation's peaking and lower end consumers are in bad shape and all that.
It's a great question, and here's how you square that circle, although I don't think it's really squaring a circle. I think it's pretty straightforward. I think what happened last year and what we're seeing as a result of that now is that inflation expectations have really lifted in a pretty significant way, right? Like this whole idea of, not to worry about inflation. The reality was people were enduring inflation then. So I think I would be, again, the view is I'd be much more sympathetic to a Fed that actually started the process last year, all in the name of keeping inflation expectations much more anchored than they would have been. And that's why I say I think last year would have been a much better approach to starting. So
we also have this question about, what the inflation picture is going to be. It's the thing that determines how many hikes and all the rest of it. Yeah. And I'm seeing more of the street turn hawkish. I mean, Goldman's notes really sound the alarm about this becoming a problem that is broad, that is going to have wage gains and wage pressures for quite some time, and that the Fed kind of shouldn't expect inflation to come back down to target, certainly in the next 12 months. Would you differ with that?
I do. So what I would say is I think what we need to keep in mind is we're going to transition this year. We're going to transition from goods spending to services spending. And one of the key things that has really driven inflation materially higher has actually been goods spending. But we're going to transition, right? And let's be clear. We normally spend a lot more on services than we do on goods. But for all of the obvious reasons, right, the pandemic sort of punctuated this idea. We spent a heck of a lot more on goods than services. So as the sort of, we sort of get back to sort of more some semblance of normal as we get into the endemic phase of COVID, what's going to wind up happening is that transition is now going to take place. You're going to go from goods to services spending. There is a mountain of inventories in the goods space right now. I mean, I know a lot of people love to, they've been highlighting sort of Home Depot over the course of the last 24 hours. They highlight all those, this big lift in inventories. But if you just look at the economic data, there's been a mountain of retail inventories for the last couple of months now. And it's something we've been highlighting. So if you have this transition where people are shifting away from goods to services spending, all in the context of a lot of inventory that's sitting out there, you can actually see goods prices that actually fall pretty abruptly, and I think much more abruptly than people appreciate. And I think that that's going to be the thing that really sort of allows inflation to slow down as the year progresses.
Very interesting argument, Tom. Great to hear from you today. We really appreciate it. Hope to check back in soon.
Shepard Smith here. Thanks for watching CNBC on YouTube.